I welcome to the second part of my discussion on revised model GST law. In my first part, we have discussed the meaning and scope of supply, valuations, input tax credit, etc. And today we are going to discuss a list of important topics, that is composite supply versus mixed supply, changes made in some of the definitions, important definitions such as the definition of goods, the definition of services, and many others. And thirdly, I will discuss the provisions related to advances. As you all understand that in GST, if customer makes payment in advance to his supplier, then a tax GST is to be paid upfront. It is not there in the VAT and central excise, but in service tax, the service tax agencies are habitual of making payment of service tax in case of advance. Then we will discuss the provisions related to SEZ. What is the status of SEZ in revised model GST law? Then the important topic which is backbone of GST, that is transitional provisions, that how the existing tax credit will be taken into GST regimes. What are the significant changes that are made as compared with the previous version of law? The one of the important topic again in time of supply, that is time of supply in case of vouchers. It was somehow ambiguous in the previous version of law. And the anti-profiteering, a new concept in context of Indian economy, Indian taxation laws. And the last but not the least, we will discuss some of the important points of cess which is going to be applicable in case of demerit goods. Now I'll come to my first topic, that is mixed supply versus composite supply. A new thought process is developed brought in this revised model GST law, that is composite supply and mixed supply. Now what is composite supply? Now they are saying if two or more goods or services are supplied in conjunction with each other and they are naturally bundled, then it is a composite supply. The next question arises, so what rate of GST will be applicable in case of composite supply, because two or more goods or services are supplied in conjunction with? Suppose if one item is taxable at the rate of 12%, the first standard rate, and the another item is taxable at the rate of 18%. So what rate of tax will be applicable on this composite supply? Now the lawmakers are saying that in case of composite supply, the tax rate of principal supply will be applicable. Now what is principal supply? They are saying that principal supply is one which constitute the predominant element of composite supply. Now I'll take one example. Suppose a customer goes to a mobile shop to buy a mobile phone, and along with mobile phone he also gets one charger and earphone. Now this is a beautiful example of composite supply. Now these three products are not artificially bundled, they are naturally bundled. So the tax rate of mobile phone will be applicable in case of this particular example of composite supply, because the main intention of customer is to bought mobile phone, is to purchase mobile phone, not the earphone and charger. But these two items are ancillary to the principal supply. Now what is mixed supply? In case of mixed supply, two or more goods or services are supplied, but that is not a composite supply, meaning thereby it is a artificial bundling of goods or services. So I will take another example. In case of festival season, when you go to buy a Diwali gift for your relatives or your friends, so in that bundle you get some sweets, namkeen, aerated drinks, that is soft drink, etc. 3 or 4 products are there in that bundle, but that is not naturally bundled. So again, what rate of GST will be applicable in this case? Now the lawmaker says the rate of tax on this bundle will be applicable of that item in the bundle which constitute the higher rate of tax. Say the rate of tax of sweets is 12.5%, the rate of tax on aerated drinks is 28%, the rate of tax on namkeen is 18%. So the tax rate that would be applicable on this bundle is 28%, that is of the of the item which carries higher rate of tax. Now we'll jump to my second topic, that is changes made in the definitions. As you all understand that the definition of goods is improved. In the earlier version, the securities were supposed to attract GST, that is shares, debentures, etc. But now the lawmakers have clearly excluded securities from the definition of goods. Now the securities are not goods nor services, meaning thereby no GST will be applicable in case of securities. The another change that has been carried out in the definition of services. Now the services definition, in the earlier version, intangible assets were included in the definition of services. A long dispute which was there in the previous taxation laws, in service tax and VAT, whether software is goods or services, was resolved to some extent when the intangible assets were included in the definition of services. But now again, intangible assets are deleted from the definition of services, and the confusion again arising whether intangible assets are goods or services. Now I will discuss some of the other important definitions that are very, very important to understand. The definition of works contract, I must tell, the definition of works contract is changed. In the previous version, works contract were defined in such a way that it will be carried out on movable as well as immovable property. Now the term movable property has been deleted, which gives an interpretation that what will happen to the contracts such as AMC contracts when I go to for servicing of my car. These processes are actually applied on movable property. So what will happen to those contracts which are applied on movable property? The confusion is again arising. The term aggregate turnover, as you all understand, that aggregate turnover is used to determine whether a person is liable for registration in GST or not. If he crosses the limit of 20 lakh as per the recent council meetings, then he is required to obtain registration under GST. But the earlier version was saying that aggregate turnover will include that taxable, non-taxable, exports, exempt, etc. But now in the revised version, the term non-taxable turnover is deleted, which is a welcome change. Now I will highlight another important change in one of the definition of capital goods. The definition of capital goods is changed substantially, and it is a welcome change. It's a business friendly definition they have given. Now they are saying, what is capital goods? Capital goods means all those assets which are capitalized in the books of accounts are capital goods. But the earlier version was saying, in fact the earlier version was referring to the chapter heading, the excise chapter headings, etc., that these will be capital goods, these will not be capital goods. But that demarcation or differentiation has gone away. Now all those assets which are capitalized in your books of accounts will be capital goods, and you can claim input tax credit subject to a small negative list given in section 17 subsection 4. A complete changeover, I would say. The chapter of electronic commerce as given in the earlier version is completely changed. Now the definitions of aggregate turnover is deleted from the law. The other definition have been shifted in section 2 of the revised model GST law. Now I will come to the last definition change, that is the change in the definition of money. As you all understand that the government is giving a lot of efforts that India as a country should become a cashless economy, a digital economy. In order to do that, the customers have to approach to the mode of digital payments. Now suppose if I am having an e-wallet in my mobile phone and I am taking money to my e-wallet from my debit card, so is that transaction is a transaction on which GST will be attracted? The earlier version had some confusions, Now the government has very clearly said that all those instruments which are recognized by Reserve Bank of India are money. If something is called money, then that particular item is out of the GST net. So the two items, that is securities and money, are not liable for GST. GST is not attracted on two items, securities and money. A lot of confusion was there in the market, in the industry, that what will happen to the advance payments. Suppose a customer makes advance payment to his supplier, then as per the time of supply, the supplier is liable for making payment to the government on the advance also, even if the goods or services are supplied at a later stage. But the input tax credit rule says that the customers cannot take input tax credit on those goods or services unless or until he actually receives those goods. So how the disclosure of advance will be made in the return? What document will be issued in case of advance? Now the government is clearly saying in the revised model GST law that a receipt has to be issued in case of advance. A receipt other than a tax invoice will be issued in case of advance, which is clarificatory to some extent. Now what will happen to the supplies made to the SEZ units or SEZ developers? Historically, they are claiming exemptions. They are not making payment of tax to the suppliers because it's a zero rated supply. Now in the revised model GST law, the IGST Act says that the supplies made to SEZ units and SEZ developers are zero rated, but they are not clarifying whether the SEZ units or developers have to make upfront payment and then they have to claim refund. If this is so, it's a huge working capital impact for the SEZ units developers. They are quite worried about it. The clarification is required from the government side. Now, important topic, that is transitional provisions. What changes that have been made in transitional provisions? The FSD/SSD, the concept which is applicable in case of central excise, is they are just passing the credit to other party. The lawmakers have clarified that the FSD/SSD can take their input tax credit into the GST regime. It was not clarified in the previous version of the law. The traders, the most important point, which was hotly debated in the industry, that what will happen to those traders who have already paid central excise duty to their suppliers, but they don't have the invoice with them. Now the government is saying that the government will prescribe a mechanism in times to come, a percentage on the basis of which the traders can take input tax credit of central excise duty. But they have to pass the benefit to the consumers also. This is the new point added. The SGST Act in the revised model GST law says that within 90 days, the dealers, the VAT dealers, has to file a statement to take their input tax credit into the GST regime, but this limit of 90 days is not given in the CGST law. The another point in transitional provisions is of transitional stock. Suppose a supplier has raised a bill on 30th of March. I assume GST is implemented on 1st of April. A supplier is issued an invoice on 30th of March, but the customer is receiving goods on, say, 3rd April. So what will happen to that transitional stock on which input tax credit is not taken by customer? Now government is saying in these cases you can file a statement. You can file a statement, the customer can file a statement within 30 days to claim that credit which was in the transition during the transitional period. The entry tax. In some of the states, the input tax credit of entry tax is admissible, but the previous version of law was silent whether that credit of entry tax will be available to the VAT dealers in the states where entry tax is admissible as an input tax. Now the government has clearly clarified. They have added value added tax and entry tax specifically to allow the credit of an entry tax in the states where it is allowed in the existing system. So This was all about of transitional provisions in revised model GST law. Now I will discuss time of supply in case of vouchers. You all understand in the new technological era, the vouchers, the prepaid vouchers, etc., the gift voucher, etc., a lot, it's used by industry a lot. Suppose a company is issuing some vouchers to his distributor, but the redemption is not known. It is not specific to a supplier. So whether the tax has to be paid at that time or it has to be paid at the time of redemption. And the government is clearly saying when the voucher is issued but it is not for a specific supplier, then the time of supply will be the redemption of vouchers. But at the time of issuance of vouchers, if it is for a specific supplier, so that will be the time of supply. So this was a new concept, new clarification that have come in the case of time of supply. And now I will discuss one of the critical topic, that is anti-profiteering in GST. People are discussing that when GST will be implemented in long term, prices will come down because the cascading of taxes will go away. The rate of taxes definitely should come down. The enhanced input tax credit will be available to the traders. A trader today cannot take input tax credit of service tax. Tomorrow he will be admissible. He will be eligible to claim input tax credit of services because GST will subsume all the taxes. So the government is planning on the lines of Australia and Malaysia that we should have a anti-profiteering law which will keep a check on the companies or to the industries that they should reduce the prices when the tax burden comes down or input tax credit increased, which ultimately the customer should get the benefit of that. But let me tell you that anti-profiteering in this revised model GST law is made applicable in case of transitional stocks. It is not made applicable when the GST is actually implemented. So this is the point we have to keep into mind. But to my mind, the government has retained powers that they can make a law, they can prescribe some penalties on the companies which are violating the anti-profiteering system in GST. Now I'll take up my last topic of cess. As you all understand that constitutionally Government of India is committed to compensate all the states if they are having any sort of revenue loss when the GST is implemented. And this commitment is for 5 years. Now the question arises from where government will arrange these funds to compensate to the states. One of the way to compensate to the states is that government should borrow money from other sources, or they should make the payment of compensation from their own funds, that they are collecting direct taxes. But in the recent council meetings, the government has decided that a vehicle will be created to bring funds into this system so that states can be compensated. So on demerit goods, 4 types of demerited goods, I would say: pan masala, luxury cars, aerated drinks, tobacco and tobacco products. On these 4 products, a cess will be levied. And what will be the quantum of cess? Now the government is saying, the Union Finance Minister is saying that the quantum of cess will be the existing rate of tax on, say, on pan masala is 60%. And the peak rate in GST is 28%. So the 60 minus 28, that 32% will be the cess on pan masala. So that the actual tax burden on these demerit goods should not come down actually. So this is the intention of government. So the cess will be creditable again. A separate return has to be filed for the cess. And it will be for 5 years. And council has also decided that the council will make a review of cess in 1 year. So this was all about cess in GST. Thank you very much for watching this video. Have a nice day.